Hey, welcome to our Wednesday, 2 p.m. Pacific time Zoom call on multifamily investing. I'm Bill Gross. I'm your substitute teacher for today. Annabelle Pacheco, unfortunately, has a family commitment and asked me to fill in. I'm the one who put her up to doing this on a regular basis and has been helping her market it. And so I'm a real estate broker as well with EXP Realty in Los Angeles, California, and been involved in multifamily and investing in real estate most of my career. And really excited today to have a professional. One of the things that you got to do if you're going to buy a property along the way, you'll need some money to acquire the property, some down payment or equity, and you'll need some financing. And whether or not you're buying it as a hard money or long-term financing, relationship with lenders is important. And so I'm really excited today to introduce a lender I've worked with for a while. Gina Koenen is with Provident Bank, does multifamily lending, has for a while. I closed a deal with her for a client of mine years ago. I get her rate sheets, her programs info. So Gina, welcome to our call today. You're muted.
Sorry about that. Yep, I got that. Good morning, or good afternoon. Day's
Good
going kind of fast.
Well, I know you guys got to be busy, and I really appreciate making time for us today. And the reason why I wanted to bring you in is this is an area that you work in regularly, and I know that your company is one of the leaders in the business as well. So tell me, before we get there, let's talk a little bit about you. Give me a little background. Where are you from originally? How'd you get into banking, and how you get into multifamily financing?
Actually, my story's odd, although I think all of us have crazy stories. I started in the military as a nurse back in, 1989. And by way of oddities and life events, I ended up in commercial lending around 2003. So almost 20 years. That's crazy.
Wow.
Like most of you guys that have been in the industry a while, we've seen a couple cycles. For me, this is my second big cycle. We had, 2008 was kind of out of nowhere. But I came originally into deposit collection back in 2003, and then found that I enjoyed sales and lending a lot more. And then I started actually teaching residential brokers how to do commercial lending back in 2009, 2010, because there were a lot of residential brokers that weren't getting single family closed as much, needed more ways to make money. And I thought, well, why not? Let's all learn how to do it so we can, cast that net bigger. So as I understand it, I'm one of the few in the industry that enjoys teaching residential lenders how to do commercial lending. So if your background is residential and you're passing on commercial loans simply because you're not sure how that animal works and what to do and how to figure out the numbers, I definitely am a person that loves taking the time to explain it and kind of work through that, because it's not rocket science. It's just understanding the terminology differences between both sides.
Yeah, and anybody who's owned a house who's most probably had to finance along the way, and so some of those principles are the same, but there's also some nuances that are different, right?
Absolutely. And Bill, can you tell me about our group online today? Is it mostly residential brokers? Is it a mix? Who are we talking with?
Well, there's both who's on here live and then who watches it after it goes onto YouTube. But I'd say the goal here is to help people who want to make their first or maybe their second multifamily investment. Maybe they own a house and want to invest in multifamily, or they've bought and sold single family residences or 2 to 4 units and want to step up. So Annabelle built this call after she had the opportunity herself to make that transition, bought an apartment building, added value to it, and flipped it, I think, for about $1 million, $1.5 million profit in a really short period of time. And so she's doing more of that. And also as a broker wants to represent people who want to do that, wants to help people find investment opportunities. I know we've worked with some people in different states that we try to promote. So the idea here is to help educate whoever is interested in the call, whether it be a new person or an experienced person, obviously.
Yeah, fantastic. Well, it's good to know who we're speaking with, because people that have done commercial, they understand the animal, but investors and people crossing over from residential, it is slightly different.
What I thought I'd do is, if I could, I got a recent rate sheet of yours. Do you mind if I share that on the screen and I kind of walk through and ask you some questions to help explain what the process looks like?
Absolutely.
Before we go there, though, if somebody had a property, at what stage do they come to you? Do they get pre-approved before they buy something like we do in residential, or is that something that maybe you'll talk to them in general terms, or what's the process before maybe I buy a property? How do I find out, if I have financing available to me or lined up or not?
Well, that absolutely is a fantastic question. Most of my customers are brokers, commercial or residential brokers. By the time they're coming to me, most people have looked at the debt to income ratio. As you would on the residential side, you're looking at the borrower from a commercial lending standpoint. We're just looking at the borrower to make sure they can afford their own debt. We're not calculating in the subject property. So we're looking to make sure they have good credit. You know, most banks, to get the best rates out there, you want good credit, no bankruptcies, foreclosures, et cetera, in the last 5 years. And we're really just looking to make sure that the borrowers, based on what they tell Uncle Sam that they make, that they can afford to put food on the table and pay their monthly obligations, their rent, their single family mortgage, things like that. The property itself, the rents that are from a commercial lending standpoint, the rents that the property generates determines the loan amount that the property supports. So you'll see with most commercial lenders that they have what they call the DCR, which is the property's version of the debt to income ratio. So we're looking at the property's net rental income to be at least 25% higher than those new annual mortgage payments, so that the property kicks off a profit in a way.
So stop right there. So hold on right there. That's great. That's a key point. I wanted to repeat that. And I think sometimes we have to hear things 2 or 3 times to understand it. So a couple calls ago, I hosted here and we went to a calculator to determine how much money is free after covering all the expenses. And you're saying that that number should be 25% higher than the mortgage expense.
Exactly, on an annual basis. Now, every bank is different, but the majority of lenders right now, we see a 1.25 debt coverage ratio, DCR. And all that says is that the net operating income should be 25% higher than the new annual mortgage payments.
And another way to put that is that the net operating income, which would be, let's say, the gross rents, and accounting for vacancy and all the expense factors, property tax, insurance, maintenance, utilities, all the actual hard expenses. So imagine you have a property that after all that, you have $10,000 left over. That can support a mortgage payment as long as that $10,000 equals the mortgage payment plus 25%.
Correct.
Yeah. Yep. So you can reverse calculate it, divide it by 1.25, and I'll tell you what the number is. So let's quickly go to a rate sheet because people are often familiar with the terms, but I'd love to be able to explain kind of what those mean. Okay, so share the screen and let's go over there. Okay, so here we are. So Provident Bank rate sheet, and here's the contact info on top if you want to reach out to Gina. So this is multifamily A loan program up to 75% LTV. So describe to me what's A loan program.
Well, as you can see in this current market, our A pricing is not really any different than the standard pricing. In a healthier market, we would see A pricing would be better pricing than the standard because you can see both of them up on the screen. Right now, they're identical. So really, there's no different. It just happens to be that in this market, we're comfortable no matter what the property is, this is our rate. But typically in a healthier market, when rates aren't quite so low, you would see lower pricing for a property that's under 20 years old. And that's what's considered our A property. You know, just the best of the best, newly constructed, beautiful, not high expenses to maintain. And so that's our best foot forward. And then everything else sort of falls under standard, which is, you know, what 80% of the apartments in California were built 1960 to 1980, and those tend to fall in the standard pricing.
And your minimum loan's $500,000. The maximum for this type of product is $6 million.
We actually will lend, and you'll see in the standard pricing where the loan amounts are, we'll go as low as 350, sometimes 300,000. There's just a rate bump under 500,000. And a lot of commercial lenders don't like to lend under 500,000. So that ends up being a niche for Provident Bank that we kind of grab the smaller loans because there aren't as many banks that like them.
Nice. So going back to standard, and then so the programs, 1 year, 3 year, 5 year loan programs, these are all term 30-year loans, but correct. The rate adjusts based on this program type, correct?
It does. You can have the 1 year, 3 year, 5 year, or even in the standard, you can have the 7 year. Basically says the rate offered is fixed for that term. So let's say we go with the 5 year ARM, which is most popular. that rate will stay for 5 years. And then after the 5th year, it goes into an arm where it'll adjust once every 6 months to a ceiling of 6% over the start rate. And this is a very common product for apartments, commercial lenders, very similar. They're usually fixed on the front end and then convert to an arm, which is very good if you're a broker. Your borrowers are constantly on a cycle of needing to refinance every 5 to 7 years. And that is nice.
So on the loan's fixed for the first 5 years, depending on which rate you go with at the interest rate. And then year 6, because it's still a 30-year loan based on the term. But in year 6, it's going to go to the index, the 1-year treasury. What's CMT is?
Yes, the treasury, the 1-year treasury.
I forget what CMT stands for.
Constant
there you
money
go.
Treasury, I think.
Treasury. Yeah, 1-year treasury bill, T-bill. And then plus a margin of 2.95 or 2.95, depending on which program you go, plus the margin. So the index plus the margin will indicate your rate in year 6 in this case, or 4, or year 2 in this case. So you're locked in for a period of time, and then it goes adjustable. And so what you're saying is that most customers, want to lock you in for 5 years, and then are planning either refinance again, or sell the property, or do something at that time.
Exactly. And something different from the residential side to the commercial is, as far as I know, 99% of all commercial loans have a prepayment penalty that is tied to the fixed period. And that ensures that rate that you get. So when you're crossing over, mentally, most borrowers are taught no prepay. And then they get mad when they see a prepay, but it is extremely common on the commercial side.
Right.
So if you think you're going to sell the property in 1 year, or 3 years, you wouldn't go for a 5-year or 7-year fixed. You would go for the shorter term.
Correct. And what's the 1-year CMT today? Do you know the index? It's going to be like below.
The last time I looked, it was 0.4.
Yeah.
But that was over a week ago. It's very low.
Yeah. So while today you might be fixed for 5 years with 3.2, and year 6 today, you might be at 3.4, 3.5. Of course, if rates jump up, it can go up, but no more than, she said, 6%.
6%
so that's
over the start rate.
Over the start rate. So the most could be is 9.2, let's say, in year 6, if we want this scenario.
Correct.
So these are different points based on which of these start rates. You have a 1 point. 1 point is 1% of the loan amount, correct? So if I get $1 million loan, 1% is going to be $10,000.
Right. So that 1 point would buy down the rate by 10 basis points. I don't know if it's worth it. It's up to the borrower to figure out. The par rate is more for wholesale brokers. When we work with brokers that have been approved with us, I would quote them the par rate, which is most common. And then the next one down is the 0.5 point rebate pricing, where if borrowers don't want to pay fees up front, they'll build their broker fees into the rate.
And you can just see that this is a 1/10 lower, but for 5/10 lower fee. So they're going to pay for it because there's a 5-year prepayment penalty. In this column, the prepayment penalty tells you the penalty is in effect for 5 years, then 5%, then 4%, then 3%, then 2%, then 1%. So it locks in for those 5 years a penalty that you're not going to want to refinance out of. If you're thinking of selling it sooner, you would use the shorter period prepay with the lower cost of the 1-year loan, right?
Exactly. Yeah.
Okay. So far, I think we're all clear. And then DCR, this is the debt coverage ratio you talked about, 1.25 and then 1.2. I guess you're a little more lenient on the standard product than on the A product. Not so much, but still. And then I mentioned, though, part of DCR is how you underwrite it. Obviously, DCR is how you underwrite it. But do you underwrite it differently than other companies or other industry standard? Or where do borrowers get tripped up thinking the DCR is 1.25 and you recalculate it and it's only 1.19, let's say?
Right. Well, and I certainly can't speak for every lender out there, but my competitors, the banks that are similar in pricing to us, similar underwriting, Union Bank, Wells Fargo, Banner Bank, all of us that are similar, we're looking for common sense underwriting. What we're going to do for the most part is take in-place rents. So even when a borrower says, well, if I buy this property, I can bump rents 30% per unit. Right. Well, until that's in place, you don't know if those tenants are going to stay, if they're going to move out, if they're going to pay market rent. So the best we can do is allow in-place rents to count for our gross rent. And then we rely on the appraisal to tell us what market expenses are. So the guy that's owned his property for 10 years and he doesn't maintain the landscaping, he cuts corners, he runs skinny expenses. That doesn't mean that if the bank gets the property back, that's what it's going to cost us. So we do lean on market expenses in that number to get to our net. And then you mentioned, Bill, the 5% vacancy. Most banks use 5% for multifamily, and that's kind of how we back into our net operating income.
Right. And it's interesting that when people apply for loans, they'll always tell you that they're getting 97 or 98%, but that's not the numbers they collect. That's not what they report, and it's not really how it works. So the bank uses 95% vacancy, 95% of the gross rent, or a 5% vacancy factor determined. So that's where the DCR, debt coverage ratio, comes in. Now, maximum loan to value, that might be true that you would lend that high, assuming that the DCR, the debt coverage, was big enough to cover that loan. But my guess is more of your loans are limited by DCR than they are by the loan to value. Is that correct?
Exactly. In this particular market. Now, we've seen the flip of that where cap rates are running 8%, and that would make, the LTV. It just depends on where we are in the market. But right now, with rates being so low, the debt cover is the limitation that pushes. You could end up at a 1.2 debt cover. You're probably looking on most properties about a 68 to a 69% loan to value.
Yeah, rarely you get to 75. So the program is there. You might as well make the LTV 95% and get people excited, but they're never going to.
Right.
Okay. So, and then for cash out, which is common, there's a lower loan to value for cash out than a purchase price. And that just being that when they're buying the property, they know the value based on the market, assuming it's a fair market purchase. On a cash out refi, they have an appraisal, but they never really know. And this is true across all lending, that they have a little more conservative underwriting. But again, my guess is it's not limited by the cash out loan to value. It's still going to be debt service coverage. It's going to be the main issue limiting your financing.
Yes, and there is a rate add for cash out, so that pushes the debt cover again. So, the banks, they're not in for risk. Everything's priced or set to risk, right?
Right. And really, this product is really ideal for somebody who's had the property a long time, and whether it's 70 or 65 or 60, it's not that big a deal to them either way. They're taking the money to redeploy capital elsewhere, is where the cash out refi is. But for the buyer who buys it and does evaluate and wants to squeeze as much money back out of it as they can, like on a BRRRR method, it's challenging with a multifamily. It's not impossible, but it's certainly challenging, and you need to get everything on your side to make that work. And certainly your expenses, you got to calculate them properly. You can't sell the bank on you're going to do your own property management. They're just not going to buy it. It's not going to work.
Exactly.
Okay, so now that's the basic program, and then your standard program, you add 25 basis points for the lower loan amounts, but basically the pricing is about the same. It looks to me just as a quick glance. DCR is a little lower, so I guess as you have properties that just don't quite make it, but with an extra 5% DCR, and of course the rate's the same, it doesn't matter in today's market. It doesn't matter much if it's a little bit different. So is that what's happening mostly? You're just kind of pushing them into the next product based on the coverage?
Yeah, pretty much. And, I'd love to match up everything on our rate sheet, but really Provident Bank is a common sense, small community bank. We lend up to $6 million, but our credit committee sits on site in Riverside. So even though the rate sheet says that, it's not unheard of that we've gone to a 1.15 debt cover. It's not unheard of that we've pushed LTV to 72, because if we like the borrower, the property makes sense. These are just kind of guidelines. They're not set in stone.
Is liking the borrower based on them doing business with the bank, or is that not how really you do business?
No, we're not one of the lenders that care about deposit relationship. In fact, as it should, it actually doesn't make a difference if the borrower puts money in the bank or not. What we're looking for when I say liking the borrower, I should have been more specific. We want a borrower with the 5 C's of credit. We want good credit quality. We want good character. We want to show that they've maintained other properties, that they pay their bills on time, those sorts of things. And so on paper, the guy that's got a good FICO score, makes good money, manages his money well, that's the borrower that we like.
There's 4 C's in diamonds, 5 C's in credit. So it tells you where the valuable things in life are. There are things you can put into a folder or a small box. Okay, good. Where do you see, I was a lender myself. I was my first part of my career
Oh, yeah.
was as a mortgage originator as well as executive for the company. Um, the So I know that there are people who come in and are shocked, disappointed that you can't do a loan for them. Where do you see what's the biggest misunderstanding or misconception of people walk in the door and find out that they're not a fit for your program? What do you see as people not being prepared or understanding as far as doing business with you?
What I see a lot of is two things. I see a lot of people that are resurfacing from over a decade ago that maybe haven't done anything with their property. And 10 years ago, 15 years ago, banks weren't looking at borrowers on a financial aspect as heavily as they are now. On this side of the 2008 to 2010 last downturn, banks are now really scrutinizing borrowers' financials to make sure that what they tell Uncle Sam they make can put food on their table and pay their bills. And back in 2005, 6, and 7, we really didn't care about what the borrower's financial picture looked like. So that's one of the hurdles that I'm still seeing the echoes of. Borrowers will come and they'll say, well, it's a 30% loan to value. Why do you care about what I have in the bank or what I tell Uncle Sam I make? Unfortunately, the regulations now are that we have to care. No matter how great the property is, no matter how small the LTV is, we still have to double check and make sure the borrower is reporting properly and can afford their own debts. Otherwise, the assumption is that they're digging into the property and setting themselves up for a probable default at one point in time. The other assumption is, and this I hear almost every day, but market rents are so much higher than what I'm getting. Why can't you use market rents? And,
Right.
and I get that every single day. And then people are agitated and irritated. And the best I can say is, well, if market rents were true, why aren't you collecting them now? Because there is a vacancy that happens. There is people, especially, well, fortunately, the moratorium on eviction is ending, but for a long time, you don't know if you're purchasing a property, how many of those tenants just aren't paying rent,
Right.
let alone not paying market.
Right. Your business, is it state specific, California only, or do you do business?
We are California only because we're basically a big, small community bank in Southern California, but we do lend in the whole state. I've got brokers all the way up to San Francisco and up in that part of the state, as well as down to San Diego. So we're all over California.
And I think I know the answer. You mentioned in the beginning you work with brokers, with commercial real estate brokers. Is your business then almost all coming from people representing the borrower as a mortgage broker, bringing you the loan package, or you're talking about real estate agents who are commercial who are referring their clients to you, and you're handling them retail? How does your business split, retail versus wholesale?
I've been with Provident now 15 years, and I get a pretty good mix. There's 7 of us loan officers, and they're all different. But having been here so long, I get sort of an outflow of direct borrowers that will call. I'll get real estate agents that are just looking for a little guidance because, like I said, I do a lot of teaching, so I get a lot of people asking that way. I'd say probably 90% of my business comes from brokers because, brokers are easier to work with, not easier than an investor directly, but they're out in the market and they're constantly, trying to turn deals. So I do get a lot of that. But what I tell the savvy investor, and I'm not trying to take food out of a broker's mouth, but a savvy investor that understands the forms that need to be done, the financials that need to be submitted, unless you need a broker to help you source a deal, there's no reason not to call a bank directly. And again, not trying to conflict, but as an investor,
Sure.
you're going to have to fill out the paperwork. So if you're
Right.
comfortable talking the talk and working with a lender directly, you can save a little money that way. It's not much, but it helps.
Well, I think it gets down to if that investor has the operations staff that they're charged and trained to do the work, they can save the money and do that in-house. It's the guy who doesn't. He's a one-man band and he's a doctor or dentist and investing on the side, sophisticated, financially savvy, but doesn't have the manpower. And that's why he needs somebody to do the paperwork. It's either going to be you, or it's going to be me, or it's going to be his staff member, but somebody's got to fill out the forms and change it to your company forms and get him to sign it. And he's screaming, there's too much paperwork, and put up with that, right? So it's either you, me, or his staff person, but somebody's got to do the work.
Absolutely. You're dead on. It really comes down to need and what you're willing to pay. And if you have the time to do the forms, you go to a bank. And if you don't, you call a broker, and all is useful.
Now we have a bit of a national audience here on this call, so we do promote people, investing in real estate around the country. Somebody said that we need somebody like you in Texas or in Georgia. So, do you network with other colleagues in the industry? Is there somebody wanted to look for a referral for somebody that would give them good service in Texas or Georgia? Do you have a Rolodex of people you work with, or colleagues you work with, or former employees, or maybe a local lender that does business in other states?
Having been in the industry as many years as I have, I always tell brokers, just email me and ask me if I know. It's hard to say off the cuff who I know, but I
Sure.
do work closely with Union Bank, Wells Fargo, Axis Bank. We know people, right? So it's
Sure.
always easier to get a warm lead.
Yep.
Out of state is a little out of reach, but I know Union Bank does most of the Western states. Axos is nationwide.
Yep.
So again, if you guys have questions and you're not sure how to place a deal, it takes me 30 seconds to answer you and try to get you a referral if I can.
Okay. We got a question. I think I know the answer to this one, which is how much down payment do you need? And the answer really is based on the loan to value, the opposite. So where it says 75% loan to value, that means they're expecting 25% down. Where it says 70% loan to value, you're gonna leave that equity in the property. But 25% loan to value would be the minimum down payment. 75% loan would be the maximum. But again, it's subject to the debt coverage ratio. And so that goes back to calculating the expenses. And the limit in today's market almost always is going to be debt coverage ratio, not the loan to value. But so you need to be ready to put down at least 25% and probably 30%. Doesn't mean you have to put the money down yourself. It could be a equity partner. There's ways to raise the money, but the lending isn't going to go more than that. They're going to look for equity at least 25%, most commonly 30 or 35%, I would think is fairly common. Is that about right?
That's absolutely true. I mean, it's the LTV and the debt cover all day long. And like I mentioned, I do love to teach on it. I've done some webinars where I really drill in and explain how to get to the net operating income, how to understand debt coverage ratio. Today, I know we don't have time for that, but Bill, I wouldn't mind teaming up with you and actually running one of those classes just to show people how that works if you were interested ever.
That'd be great. Oh yeah, let's reach out afterwards. We'll schedule that in a couple of weeks maybe, huh?
Yep.
So if someone want to reach out to you, I have your email on this rate sheet. Can I give out that email address?
Absolutely.
Yeah, so I'm sorry.
And just to everyone, if you call me, please don't get too frustrated. I talk a lot, so when I'm on the phone, I'm on a long time. So don't be afraid to send me an email and tell me to call, or if you have a quick question, ask it by email. It's not that I don't like to be on the phone. It's just I talk so much. I'm always on the phone.
I am with you on that. I tell people the same thing. Leave me a message. I can call you back when a good time is. So her email is how do you pronounce your last name? Koenen?
Yes. Good job.
Koenen at myprovident.com, myprovident.com.
Yeah.
And her email address is myprovident.com/gkoenen.asp is her personal webpage. It has her other contact info and her pretty picture and all that stuff on there as well. And then stay tuned. Well, we're going to do some additional follow-up as far as classes and go through the debt service coverage. I went through it at a higher level just quickly to say, here's the concepts, but to have somebody actually underwrite these packages for realsies, if that's a word, would be real powerful for everybody. So stay tuned for additional information there. Any other questions while I have her on the phone now? Password present plugin. Well, I don't know what that means. We don't want that. Any other questions we have for Gina at this time? Not seeing any or on social media. We have a nice turnout today. So I know we're going to stream this to YouTube as well. If you have comments, if you're watching this on YouTube, put your questions in the comments. Annabelle will respond either with the answer or reach out to Gina. And then we'll set up a follow-up. We're going to go into detail. Again, we talked today about the DCR, the debt coverage ratio. That's based on calculating the income and the expenses on that property and how the bank does it. And that's the basis they use to determine lending. So we'll do a follow-up and go into that more detail. Okay, well, Gina, that's actually the most common mistake people make. What do you, just to kind of to wrap up here, you deal with people who are fairly modest and have a nice investment or two. I'm sure you deal with people who are fabulously successful. What do you see for somebody who's getting their first or second investment and breaking through that first transition from I want to be an investor to being successful? What do you see as a common trait or activity of those people who make that transformation and move forward?
I think it's true in anything new is the person that is open and understanding of how that animal works. So, the people that are digging their heels in and swearing, well, I don't like the way that's done. I don't like the way that's done. It really comes down to fluidity and flexibility. And if you lean on the experts in the industry and say, teach me how it's done, let me learn to talk the talk and walk the walk. Once they digest that, yes, it's probably going to take 30 to 35% to put down, you kind of get into that and you start rolling forward with that. Be open to learning at all turns. Those are the people that just flow into being successful. It's just like with anything else in life. If you dig your heels in and fight, you're just not going to grow and learn. Correct?
I agree 100%. And, I had a chance to study recently with really a master investor, Grant Cardone, who has a portfolio of multifamily properties and just has built an incredible business around that. And his style might be a little rough on the edges for some people, and for me, to be honest, initially especially. But he's a master investor. And one thing he said that stuck true for me is real estate, it's critical to be in partnership with a lot of people. It doesn't mean you're physical partners, you have a partnership agreement, but you have different vendors that you rely on, that you trust, and they trust you, and you build that over time in relationships. And so getting a chance to not just find the rules from a lender like Gina, but to actually learn, and maybe when it's time, get a chance to meet with her and have her evaluate the deal, learn from the mistakes, grow, next time bring it back, do a better job. That's how we grow in real estate, and as investors in particular, because it's a challenging business. So,
yeah,
well, look,
Bill, that was very, very well said. And I learned that from some young brokers a while back that were like, well, it's just a one-off. It's just a one-off. Let's just get it done. And I said, well, it really isn't a one-off, especially in commercial multifamily. You've constantly got borrowers turning their loans every 5 to 7 years. You are correct. It's who you know. It's building those relationships because they all come back around.
Yep. And that's where you get the little better debt coverage ratio, or a little better loan to value, or a little better decision on underwriting. You get a little bit at the margins. I think that's the key that you work towards. But it takes time to earn that credibility, and your reputation in real estate is really, really important. So, well, good. I think that's everything we covered for today. Gina, again, thank you on behalf of everybody on the call today, and on behalf of Annabelle, thank you so much for being on our call today. We'll follow up with a chance down the road to do it again, and we'll promote it as a more in-depth class on underwriting a deal and how you actually calculate the numbers. But really, I appreciate this. I got a true confession here. This is short notice. Unfortunately, Annabelle had a family emergency, asked me to sit in, and then I had somebody lined up who backed out. And so I really just called Gina this morning. We've only done one deal, I think, in my career with her, but she's always very helpful on the phone and quick to either say yes or no. And we did a deal years ago, but it was something that somebody else had turned down as well. But really, I just really appreciate, Gina, your willingness to help people today on the call and in the future. So thank you so much. We'll look forward to working with you again soon.
You're very welcome. Thanks for the invitation.
Okay, everybody. Hey, again, this is Annabelle Pacheco's 2 p.m. Wednesday afternoon multifamily call. We do every week. It'll be on YouTube as well. I'm Bill Gross. You can reach me. I'm at probateweekly.com. I do every Thursday at 4 o'clock. Or you can see me on YouTube at Bill Gross. EXP is my YouTube channel. Look forward to seeing you soon if I can help you. Thank you so much, everybody.